the confusing parts over this past, let's call it since the global financial crisis, that has thrown a lot of people off, is that they assume money printing must be inflationary. Whereas another way of looking at it is that it can be anti-deflationary.
Right.
That you don't so you don't assume that the base case is like roughly zero inflation. You might assume the base case is deflation in a certain type of environment, like a big debt bubble going off. And when you expand the monetary base, you set off a series of changes that prevent that deflation from happening, which is, it's another type of inflation, but it's not something we would generally think of as inflation.
Since 2020, a prevailing theme I've emphasized is the potential inflationary impact of this decade's fiscal policy, challenging the conventional effectiveness of interest rates as a policy tool. Lyn Alden, an independent investor and macro analyst, navigates the intricacies of this economic landscape, acknowledging the shifting dynamics. When sovereign debt is low and money creation is primarily through bank lending, higher interest rates act as expected, slowing loan creation and inflation. However, in scenarios with high sovereign debt and substantial money creation from fiscal deficits, the relationship becomes a complex interplay between dampened private lending and increased deficits. The United States stands on the cusp of this complex interaction. Annual fiscal deficits have exceeded loan creation in dollar size, yet the impact is balanced by a restrained propensity to spend interest income. This delicate equilibrium, where fiscal deficits play a significant role in money creation, leads to a unique correlation between higher interest rates and inflation. Alden's insights provide a valuable lens to which to understand the nuanced dynamics of monetary policies, inflation, and the intricate Bitcoin-to-dollar proposal.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
Generally, what these environments shared is that, leading up to the Great Depression and leading up to 2008, you had a situation where the multipliers were very significant, meaning that the number of deposits that a bank had that they owed liabilities in compared to how much base cash they had was very wide. And also
But
how
how are
much
you measuring that cash?
different ways. You can either look at just deposits in the system compared to the monetary base, or you can look at deposits in the system compared to the amount of money that banks list as cash, which is either vault cash or bank reserves. If you're on like an older money standard where say the money is gold, right? If something unravels this big debt environment, you can't print more gold. So you're going to have some sort of peg break. You're going to have some sort of deflation, either deflationary collapse or peg break. It's kind of your options start to condense down. Whereas what makes this money printing essentially is that now authorities have flexibility over the monetary base. So the third option is basically instead of a peg break, they can maintain those claims because they increase the monetary base and they make banks less reliant on interbank lending. But then it kind of retroactively makes all of their deposit growth and their fractional reserve banking, it kind of solidifies that. It says that is now, we've given the choice between M2 starting to collapse down closer to the monetary base or the monetary base expanding upward to meet M2. They basically say that we will always err on the side of, the monetary base expanding upwards to make most M2 money good. What you generally have in these crisis environments is that you have an inherently unstable system. Like, basically that no more than 5% of people could want to withdraw cash at once because there's really not, the base cash isn't there. There's only so much base cash. If the whole system's only levered so that there's basically like back in 2008 there were like 23 deposits for every $1 in what banks called their cash, which is like vault
Right.
cash combined with some reserves. Now, if any one bank, let's say one bank had 20% of deposits want to come out of it in one day for some reason, maybe they have a really big concentrated depositor. That bank could meet that no problem by going over to Wells Fargo and saying, hey, we just got to meet this like liquidity requirement. But if the whole banking system were to one seize up, so they can't, they don't trust each other anymore, and
But
they
that's
can't.
an increase in counterparty risk.
Yes, but the reason it happens is because they realize like that the money's not actually there, or at least most of the money's not actually there. So if the music stops, and if say 10% of the whole deposit base shows up and says, "Oh, okay, I want my dollars right now," there's literally one is there's not even enough printed dollars, and two, even if you include reserves and things like that, there's not that many base dollars.
Democratic presidential candidate Robert F. Kennedy Jr. has outlined his Bitcoin plan in the context of the upcoming November 2024 election. Speaking at the Heal the Divide event, Kennedy, the nephew of former President John F. Kennedy, revealed his intention to exclude capital gains tax on the conversion of Bitcoin to dollars if he assumes office. While acknowledging potential drawbacks, Kennedy believes that the advantages for the United States could far outweigh any disadvantages. He asserts that this tax exemption would not only safeguard civil liberties but also draws parallels to the Clinton administration's e-commerce tax exemption policy. Kennedy's vision extends further, as he proposes linking the US dollar to Bitcoin, envisioning a symbiotic relationship wherein the leading cryptocurrency could contribute to the stability of the greenback. The proposal has garnered attention, prompting commentary from Lyn Alden, who provides her insights on the matter. Intriguingly, Lyn Alden offers her perspective on Kennedy's proposal, shedding light on the potential implications and merits of such a groundbreaking policy shift. Let's now listen to Alden's commentary as she shares her thoughts on this innovative proposition.
Because there's a difference between reserve accumulation and actual backing. So reserve accumulation would basically say, okay, our Federal Reserve is going to be, and Treasury, actually more specifically, is going to be allowed to and even tasked with increasing its hard assets, right? So you say, okay, instead of just holding our supposed 8,000 tons of gold flat, we want to go out and buy more. And, we want to add a certain percentage of Bitcoin to that mix as well, so that there's more reserves in the system. That's one statement. I think it's an arguably reasonable thing to do. I mean, it's probably dollar negative while it happens, but then they'd have more ammo if they should ever want to defend the dollar. That's just generally how emerging markets manage their exchange rate. Is one of the things they do is expand reserves or contract reserves. So that's an option. Now, if you actually wanted to back it in terms of redeemability, the challenge is that you have to have quite a lot of it. So the way this would work on the gold standard, for example, is that you might have 40% of your monetary base backed up by gold. And if there's too many redemptions happening, that's what you'd have to increase interest rates, because you want to entice more gold to enter into or at least you want to stop the outflows and entice more existing gold to come back in for people that say, okay, I trust the system and I want to get that higher interest on that gold by depositing it. And then if they're ever in a situation where they have more gold than they need, let's say they have 50% and their mandate's 40%, they can cut interest rates because it doesn't matter if there's a little bit more redemptions happening. But you can't generally do that when you're talking about 1%, 5%. And the longer term challenge goes back to our earlier point about fractional reserve banking and how these claims tend to proliferate faster than the underlying base can.
Right.
And so when you have banks that are not full reserve banks, so they're not doing duration matching, they're doing fractional reserve banking, they're generally increasing the total claims in the system more than gold's increasing. And so as long as that's redeemable, you're probably going to get drained. If you look at the Bretton Woods system, it's interesting because it was proposed in obviously 1944, but it wasn't fully implemented until the late 1950s. That's when it was fully set up. The exchange rates were
We're locked.
all that stuff was it was kind of all planned for that first 15 years, and then it was okay, we're going live. And if you look at U.S. gold reserves, they just started dropping almost every single year like a stone.
Yeah.
As soon as you had that, until it just broke. Then they said we can't do this anymore. So a lot of people, when they look at the Bretton Woods system, they say the problem happened in 1971. It's well, no. The problem happened the second you went live with a system that didn't fundamentally make sense, because you didn't constrain the number of IOUs, bank deposits. You didn't constrain the number of euro dollars. So you had fractional reserve banking built on fractional reserve banking. This was all proliferating.
No reserve banking.
Yeah, and all this is now redeemable for gold. And so people kept saying, well, I'll take the gold then. So you started rapidly draining gold while increasing M2 and increasing euro dollars, and eventually the ratios got silly and broke.
El Salvador's 2027 bonds have surged by over 60% since the year's commencement, mirroring Bitcoin's price upswing of 80%. These government bonds, serving as debt instruments, are issued to raise funds for state expenditures. In contrast to dire predictions made in September 2022, which forecasted a debt default by January 2023, El Salvador not only averted this default but also successfully repaid an $800 million bond in January. The country's bond rally coincided with Bitcoin's surge, bolstered by factors such as the appointment of former IMF official Alexandra Werner as a finance ministry advisor and El Salvador's adoption of Bitcoin as legal tender in September 2021. Nonetheless, reports reveal mixed outcomes for the country, with increased tourism but limited domestic cryptocurrency use. Bitcoin has demonstrated remarkable growth, exceeding an 80% surge since January, influenced by various developments including the Federal Reserve's pause on interest rate hikes and BlackRock's pursuit of a spot Bitcoin ETF. Despite such advancements, certain U.S. senators express reservations about El Salvador's Bitcoin integration. Concerns over financial and economic stability, money laundering, and illicit finances prompt a call for clarity. El Salvador's bold move and its consequences underscore a growing institutional inclination towards Bitcoin incorporation. Considering the ongoing drive to integrate Bitcoin into financial systems, the feasibility of a Bitcoin-pegged dollar prompts thought-provoking discussion. We welcome your thoughts and insights on this matter in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.